If the only time you look at your P&L is when your tax return is due, you're not managing your agency, you're reading last year's obituary. And by the time you find the problem, it's likely already too late to fix it. I'm Cody, I'm a CPA, and my firm works with marketing and PR agency owners who want better profit, better cash flow, and smarter tax planning. And one of the first questions I ask every new agency prospect is real simple. How often do you look at your P&L? That answer tells me a lot. It tells me whether the agency owner is managing by the numbers or managing by the bank balance, the gut feeling, or hope. Today, I want to walk you through the monthly financial review every agency CEO should be doing, because agencies that catch problems in March have options. Agencies that discover problems on April 15th usually have excuses. So your P&L is not a tax document, it's a management tool. A lot of agency owners treat their profit and loss statement like something their accountant needs once a year. And that's a big mistake. Your P&L should tell you whether your business model is working, not just whether you made money last year. For a marketing or PR agency, you should not just be looking at top-line gross billings, because that number can be misleading. If you collect a large media budget from a client, that money may pass through your agency, but that does not mean you can spend it. The number that matters is agency gross income, AGI. Agency gross income is what is left after your direct client costs and pass-through expenses. That is the money available to pay your team, cover overhead, invest in growth, and create profit. So your monthly review should start with this question. What was our agency gross income this month? Not just total deposits, not just invoices, not just what hit the bank, agency gross income. Because if you manage the agency off of the wrong number, every decision after that may be wrong. You may think you can hire, you may think you can invest in growth, and you may think you can expand. But if the AGI is not there, you may be building your plans on money that was never really yours. Monthly reviews catch profit leaks while you can still fix them. Here's the real value of monthly financial reviews. They give you time. If your people costs are creeping up, if client margins are slipping, if one retainer is quietly becoming unprofitable, you want to know that now, not 9 months from now, not when your tax return is being prepared, not after cash gets tight. A strong monthly financial review should look at a few key areas: agency gross income, people costs, overhead, net profit, and cash flow. If people costs are too high as a percentage of AGI, that's a warning sign. If overhead is growing faster than AGI, that's another bad sign. If the team is busy but profit is shrinking, that's another warning sign. And that usually means something's broken. It could be pricing, it could be scope creep, it could be utilization, it may be the wrong mix of clients, it could be that a project team is spending way too many hours on work that was priced too low. But here's the point. You can't fix what you don't measure, and you cannot measure it accurately once a year. A monthly review gives you the chance to adjust pricing, staffing, billing, collections, or delivery before the year gets away from you. And that's the difference between proactive financial management and tax time cleanup. Your balance sheet matters just as much as your P&L. Most agency owners look at the P&L first, and that makes sense. But the balance sheet tells a totally different story. And sometimes it tells the story the P&L misses. Are accounts receivable growing? Are clients paying slower? Are you carrying deferred revenue? Are pass-through client funds sitting on a balance sheet correctly? Are your payables building up? Are tax payments being estimated correctly? And this matters because an agency can look profitable on paper and still be under cash pressure. Or the opposite can happen. You may have cash in the bank because a client prepaid for media, production, or another pass-through cost, but that does not mean the agency is healthy. That cash may already be spoken for. And this is where agency owners get into trouble. They look at the bank account and think, we're fine. But the financials tell a different story. And that is why your monthly review should include both the P&L and the balance sheet. The P&L tells you performance, the balance sheet tells you position, and you need both. If you file your taxes on a cash basis, that monthly accrual to cash conversion is critical. A lot of agencies manage the business on accrual basis, and that makes sense. And accrual accounting helps match income and expenses to the period where the work actually was performed. But many agencies file taxes on a cash basis, and that creates a disconnect. Your accrual P&L may show one result, but your taxable income may be very different. And no, simply clicking the cash basis button in QuickBooks, Workmajig, or another accounting platform may not give you the full answer, especially in the agency world. Well, why? Because agencies often have accounts receivable, accounts payable, prepaid costs, deferred revenue, retainers, pass-through funds, and timing issues that do not always convert cleanly. So each month, your CPA should help you understand, what does the accrual P&L say, and what does the cash basis tax picture look like? And are we planning for taxes based on reality? This is where monthly work matters. If you wait until tax time, all you can do is explain what already happened. But when you review this monthly, you can make better estimated tax payments, you can avoid surprises, you can plan before deadlines, and you can make decisions while there's still time to act. Let me ask you, how often are you really reviewing your agency financials? Monthly, quarterly, or at tax time? Drop it in the comments. And my second part of that question would be, are you reviewing those numbers with your CPA? You should be. Tax time accounting is not the same as real-time financial partnership. One of our recent tax day posts got strong engagement, and I think there's a reason it resonated. Agency owners know the tax time scramble is broken. They know that dropping off financials once a year is not enough. They know that by April 15th, most of the good planning opportunities are already gone. This is why we meet with clients throughout the year on a monthly basis, because tax planning is not something you do after the year is over. Cash flow forecasting is not something you do when payroll gets tight. Profit improvement is not something you do after you already missed your target. You want to catch your problems early, and early is March or June or September, not when the tax return is already being prepared. Drew McClellan and Agency Management Institute have talked for years about the importance of agency owners knowing their numbers. And from my side as a CPA working with agency owners, I can tell you this: the monthly financial review is one of the highest leverage habits an agency CEO can build. Not because it's complicated, but because it forces clarity. So let's recap. If you only look at your books at tax time, you're running blind. Your P&L should be reviewed monthly as a management tool, not just a tax doc. You should manage from agency gross income, not gross billings. And you should review your balance sheet, because cash in a bank does not always mean available cash. You should track your people costs, your overhead, and profitability and cash flow every month. And if your books are accrual, but your taxes are cash basis, you need a proper accrual to cash conversion on a monthly basis, not once a year, but month. That is how you catch the problems early. That is how you make better decisions. And that is how you build an agency that's more profitable, more tax efficient, and less stressful to run. All right, before you go, if you're an agency owner and you want to keep more of what you make, I've got two things for you. First, grab a copy of my book, The 12 Biggest Tax Mistakes That Cost Agency Owners Thousands. It breaks down the exact mistakes I see every day and how to avoid them. Second, if you want to see what this looks like for your business, get a free tax analysis. We'll take a look at what you're doing now and show you where you might be overpaying. And if this video helped you, make sure you subscribe so you don't miss future strategies on tax planning, cash flow, and building a more profitable agency. I'll see you in the next video.